So far, the risks haven't been clearly and fully reflected in stock prices, Brent crude prices, and import and export prices. Current measures are keeping oil prices relatively controlled. Now, when saying this, we need to zoom out and look. When was the highest price? That's $120 plus at mid-year 2022, which was during the Russia-Ukraine war. Currently, it's hovering at around $100 mark. And yes, many are very uncomfortable with the spot price being much higher than the 100-day moving average line in red. That means the current price has picked up very quickly, and analysts warned that the measures will soon lose their effectiveness in early to mid-April. A quick background: Iran is causing a standstill in the Strait of Hormuz. Many vessels can't move. They can't ship out oil because Iran has been attacking civilian ships and energy infrastructures, and about 1/5 of global oil supply passes through the strait. Now, some oil has been rerouted through pipelines, but it's still not as efficient, and countries responded. The U.S. and others released 400 million barrels of oil from the strategic reserves. The U.S. also temporarily lifted sanctions on some Russian and Iranian oil. Shell's CEO commented that the disruptions has moved to Southeast Asia, Northeast Asia, and into Europe as we get into April month. This chart at the right, like the previous one, is a comparison of showing when the previous highest point was, which was mid-year 2022. The prices that we see in the news and press are paper prices. It's what financial markets trade. And paper prices generally drop whenever Trump mentions de-escalation of the war. So because of that, paper prices typically are lower than the physical delivery of oil prices. Let's compare the two. The paper price, that's the Brent crude futures, which is the chart on the right. Since the last trading day before the war on February 27th and 1 month on to March 27th, the price jumped 36%. Physical price, Dubai price, which tracks physical delivery, it went up 76%, more than double of paper price and even more of volatile. For now, through roughly end of April, the world has lost about 5 million barrels of oil per day. Now that's a small 5% of global supply, but it might double in mid-April. And Trump moved troops to Iran. He could use them to attack Iran's oil export facility, which will cut off Iran's vital revenue source and could force them to accept the negotiations and reopen the Strait of Hormuz. But of course, that'll reflect very badly for the U.S. Trump also extended the pause of attacking Iran's energy facilities to April 6th. The reality of the price of physical delivery of oil being much higher than paper price leads us to this topic. Surging energy prices, rising import costs, and stagflation are pushing the likelihood of Fed's next move to be an interest rate hike. Traders priced in the probability of interest rate increase to late this year at 25.5%. That could happen on October 30th. The probability might increase if Iran war drags on. At the same time, import prices jumped 1.3%. Export prices also jumped, but at 1.5%. Now imagine you're a proud made in America apparel clothing brand. For example, US-made jeans or sportswear. This is a double whammy because you have to pay more when importing materials, and if you're exporting out. The OECD increased their forecast for U.S. headline inflation number to 4.2%. The previous forecast was 2.7%. But then, FOMC Vice Chair Philip Jefferson commented that while in the short term, it's complicated, he's confident that the current policy stance is well positioned. He's trying to calm the markets that the rate hike won't be so soon. And so, inflation leads to the talk of recession because the U.S. GDP is heavily driven by consumers, which contributes more than 2/3. When inflation gets very high, consumers will feel the pinch and spend lesser. Rating agencies, financial institutions, and consulting companies shared their views. Moody's said chances of recession in the next 12 months are about 50%. Goldman Sachs said 30%, and EY said 40%. But bear in mind, in normal times, it's 20% in any given 12-month span, while it's hardly a certainty, but the risks are still high. It's important not to respond immediately and trade based on news. Instead, stick to your investment plan. In fact, well-balanced portfolios like 60-40 or 70-30 splits are still well. And some background that adds on to the talks of recession is the labor market. The whole of last year in U.S. isn't very well. The U.S. economy added 116,000 jobs last year. But in February this year, they lost almost all of it. They lost 92 jobs. Employment is the key driver for consumer spending, and consumer spending is the key driver for U.S. economy growth. But on the bright side, while human beings are losing jobs, a lot of it were replaced by AI, which businesses tend to benefit from cost reductions and improving operating efficiencies. Some might even generate revenue quicker with AI. And this is the thing that will help with the prices of publicly listed instruments. Another concern is the stock market. The stock market was very good in the past 2 years. That brought the wealth effect to consumers, which helped 20% to 25% of spending growth. But now the stock market has been constantly declining. Consumers will typically hold back in spending on big-ticket items. Trump recently issued this 15-point peace plan to Iran, and obviously it's going to be biased towards the U.S. It's unclear whether the Iranians really receive it or not. It's also unclear if Israel will agree with the plan. And one of the points is Iran can't have a nuclear weapon. Trump will pause attacking Iran until April 6th because he is demonstrating that he wants to negotiate this and end the war. And the key thing is to quickly open up the Strait of Hormuz. Obviously, Trump wants oil. From what we saw in Venezuela, the U.S. has high supply of light crude oil, but requires high amount of heavy crude oil instead. America needs heavy crude oil to keep its automobiles fed with gasoline, but majority of oil produced in America is light crude. So G7 finance minister, energy minister, and central bank governors. It's their 4th time meeting since the Iran war. There's skepticism over the repeated meetings because they have led mainly to monitoring, coordination, and stockpile discussions, not major action. With Trump's America First approach, it seems increasingly unlikely that the G7 can be the diplomatic vehicle to de-escalate the war. Some positive news here, but it won't happen so soon. Trump and Xi Jinping will meet in Beijing on mid-May. Hopefully, there's going to be positive outcome out of the meeting. One tactical move that you can consider is this exchange-traded fund, ProShares, short S&P 500. Its price is designed to appreciate whenever the S&P 500 drops, at least on a daily basis. It goes 1 times inverse in that it seeks to deliver the opposite of the S&P 500 index's daily performance, before fees and expenses. For example, if the S&P 500 falls 1% in a trading day, this exchange-traded fund aims to rise approximately 1% that same day.